It's another edition of the Trading Tips video newsletter, teaching you how to become a successful trader in less than 5 minutes per week. The video newsletter is brought to you by TradingTips.com.
Welcome to this video newsletter on double bottom chart patterns, catching stocks on the rebound. In this episode, you'll learn how to spot stocks in the double bottom chart formation, one of the historically most bullish patterns, and how to distinguish a bullish double bottom from a bearish double top. You'll also learn when to take profits. Let's begin. A double bottom formation begins when a stock drops precipitously to a new multi-week or month low and then quickly rebounds. However, the initial rebound is short-lived and the stock reverses again, falling to a second bottom that's very similar in price to the first one. From here, though, the stock breaks out. Double bottoms sort of look like W's. Let's look at an example. Here are drawn in the distinct bottoms of this double bottom chart formation. Notice the bottoms come to points. In order to be a double bottom, a stock has to quickly rebound from its lows, not drag them out. Also, notice how this chart pattern looks like a W, not an M. An M would represent a double top. A double bottom is essentially the inverse of a double top. And as double bottoms are bullish, double tops are bearish. You can easily distinguish a double bottom from a double top, as double bottoms make W's while double tops make M's. Only very rarely will a stock chart make both a W and an M. In the previous example, the chart did not form an M, only a W. It was a solid double bottom, one of the historically best performing chart formations in the history of stock trading. But now that you can spot a double bottom after the fact, how do you trade it? In other words, how do you know a double bottom has occurred before it breaks out to huge gains? First, recognize that the two bottoms create a support line. If a stock falls below these levels, it has broken the double bottom chart pattern and should be sold or avoided. Secondly, in order for the stock to be in a double bottom formation, the second bottom has to be within 3 to 4% of the first bottom, and the failed advance, i.e. the first top, should be 10 to 20% greater than the first bottom. Finally, wait for the stock to show some strength coming out of the second bottom. You won't know the second bottom has even formed until the stock rebounds a bit off the low point. Here's a real-life example, United Technologies in late 1998. Notice the two bottoms are within a few pennies of each other. The high point in the middle is about 17%, which is within 10 to 20%, greater than the first bottom, and the stock had a strong showing coming out of the second bottom. This all predicted the huge breakout shown here. As you can see, within about 5 months, the stock went up nearly 50%. Not bad. But this raises the question, when do you take profits? Knowing when to sell is even more important than knowing when to buy. Most novice traders sell their winners too early, but there's also a danger of getting greedy. Luckily, there's a good technical rule for double bottoms. Sell when the breakout doubles off the previous top. To understand what is meant by this, let's take another look at that United Technologies chart. Here's the same chart for United Technologies, with a few helpful visual aids drawn in. I've extended the double bottom line, the support, across the chart, as well as the failed recovery top. This is so we can visually represent the distance between the first of the two bottoms and the top of the failed recovery, which I've done with the black vertical line. The technical rule for double bottoms is to take profits when the stock has gained this amount again, which I've represented with the vertical red line. The horizontal red line represents the points at which it would have been prudent to take profits, when the breakout had doubled off the previous top. To recap, double bottoms are bullish rebound patterns that consist of a precipitous fall, a failed recovery, another fall, and finally a breakout, forming a W. It's prudent to buy once the stock has broken out a bit off the second bottom, and to take profits when the breakout doubles the price achieved by the failed recovery. We hope you've enjoyed this video newsletter on double bottom chart formations. Thank you and have a wonderful day.
This Trading Tips video newsletter has been brought to you by Manny Bacchus's First Hour Trading System. Every day there's money to be made in the first hour of stock trading. This is the world of day trading, not for novices, unless you have a system. The First Hour Trading System. Visit firsthourtrading.com now and sign up for a free 30-day trial. You could make enough in the first hour of your day to take the rest of the day off. Do you want to view more Trading Tips videos? Visit tradingtips.com. Sign up for our free video newsletters. Become a successful trader. by visiting tradingtips.com.